Hi everyone, this is Ted Bauman here, editor of the Bauman Letter here at Banyan Hill Publishing. In today's video, I want to talk about something that a lot of people have been writing into me about in recent weeks, and that is why we are not selling stocks under these circumstances. In fact, why some of us here at Banyan Hill are continuing to buy stocks under these circumstances. Well, at first blush, that would seem to be kind of an odd question. Of course, we're buying stocks because there are many valuable opportunities to be had out there in the market. The bigger question is, why aren't we selling stocks if their prices have declined so much? Why are we holding on to these losing bets? Well, the first thing to understand is that the situation that we're facing right now in the stock market is completely unlike any other situation that we've ever faced. The best metaphor that I've seen people, or rather simile, that I've seen people use is that this is like a natural disaster. It's like what happens in a hurricane or an earthquake or something like that. In a normal recession, everybody suffers. The economy's, or rather companies' earnings go down. The expectation of the stock market is that their earnings will go down. And so their stock prices decline because ultimately we're buying stocks for their future earnings. Now, in that case, we can see this coming. We know that there's going to be a recession at some point. We know that the business cycle will likely cool down. And so we can say, well, in these sectors, we better, take our profits and move on. Well, in this particular case, nobody knew that this virus was going to become a global pandemic. Right up until a month ago, the World Health Organization was saying that it wasn't a pandemic yet. Now, you can point fingers, I can point fingers at various government officials and the WHO and all kinds of organizations and say, well, you should have warned us. The bottom line is that stocks are going down because the world is on a pause. It's on an economic pause. I described it in a note to my Bauman Letter readers as saying that essentially the global economy has gone into suspended animation. Now, under those circumstances, yes, you would expect companies' earnings to decline. In fact, in some cases, they may dwindle to historically low numbers that companies have never seen before. But does that mean that all future earnings for these companies are, going to evaporate? They're never going to come back? No. For a lot of companies, yes, they are going to come back, and they're going to come back strongly. And here's where I want to talk about the relationship between stock price declines in a normal recession and the kind of thing that we're seeing right now. In a normal recession, we see gradual declines as the reality of the idea of a recession emerges. So, for example, you might have a company that will lose over the space of a month or two, 5 or 10 or 15% of its stock price. We can see this coming. We can get out of the stock in time. In this case, over the space of a couple of days, we saw stocks lose 20, 30, 40, 50% of their stock price value overnight, faster than anybody could anticipate. Now, under circumstances like that, it's really beyond the capacity of any normal person to be able to predict and say you should sell stocks before this happened. I've had a couple people who have come in and said, well, I sold my stocks before the crash and I'm feeling really good about it. Aren't I smart? Well, you're lucky is what you are. Unless you did it because you had information that the rest of us didn't have. The bottom line is that companies that have lost this enormous value have lost them for a specific short-term reason. It would be suicidal, it would be throwing away money to sell stocks that are down by 30 or 40 or 50% that still have excellent future prospects once this crisis is over at those price points. You'd simply be losing money. So the reason why we're not selling stocks, most of us here at Banyan Hill, and certainly not in the Bauman Letter or in the Alpha Stock Alert that are down, is because we know these stocks are going to come back up again. And when they do, they're going to come back up just as fast as they went down. Now, under normal circumstances, it might take a long time for a company to regain from 50%, 40% loss of stock price. But in this case, we anticipate it'll be just as quick as it was going down, maybe a little bit slower, but it's going to happen. So the bottom line is the reason why I'm not advising people to sell stocks that are down in their portfolios right now is because you'd simply be throwing away money. Now, there might be cases where companies have difficult prospects where they might suffer so much under the crisis that they actually cannot resume their business. And in those cases, we would definitely recommend taking whatever profits you can, or rather cut your losses in most cases. But we don't have any companies like that, and so that's why I think most of us here at Banyan Hill are not recommending that we sell. Now, that raises the question of stop losses. I know a couple of people have asked a lot of us here at Banyan Hill, why aren't we using stop losses? Well, again, there are two reasons why a lot of us don't use stop losses. One is that if you're buying a company, because you think it has long-term earnings potential, then a stop loss will simply force you to sell as a result of sometimes the normal volatility of the market. And as I've said many times, the market is a lot more volatile now than it used to be because of computerized trading and options trading and all this kind of derivatives trade that makes markets extremely volatile. So if you put in a stop loss at say 8 or 10% or something like that, the chances are that you'd be buying and selling a lot of stocks simply because the markets have been very, very volatile, not just recent, but even before this, going back to the Chinese trade conflict. So the bottom line here is that we don't sell under these conditions. We suspend our stop loss strategies, and we think that that's the best thing for you to do too, because you don't want to be stopped out of a position based on a strategy and a decision that is made for normal market conditions. These are not normal market conditions. So first point I want to make is do not panic and sell stocks. And I think that is an important thing for all of us to remember right now. The only time to sell is if a company, it looks like its survival is threatened as a result of what's happening. Hopefully the bailouts will prevent that. Now, there's a second set of questions that relate to how one's portfolio should be designed. Now, in a sense, this is kind of closing the barn door after the horse is gone. But one of the problems that I've detected with a lot of people is that they seem to have piled a lot of money into very specific companies and they haven't diversified. And when a company drops by 30, 40, 50%, they're in a complete panic and they think that the world has come to an end. Well, it's too late to reorganize and rebalance your portfolio now, and I would certainly advise against rebalancing based on current prices. We should wait for things to normalize. But you shouldn't be in that situation in the first place. It's important to maintain diversity in your portfolio, to equal weight your positions so that each position is roughly the same amount of money invested. Don't pile into just a few stocks because that's risky. If you want to limit your investments to just a few, use exchange-traded funds. Don't buy specific companies and pile everything into them. So portfolio balance, equal weighting, and the most important thing is to stay smart and stay tough in situations like these. I know it's upsetting. I mean, whenever I see a stock in one of my portfolios that has gone down by a lot in the context of this crisis, and everybody's, the stress that we're all under, and we're all working at home, and we've got trying to make our, in my case, trying to help my kid with her homework and all that. It's tough. But the bottom line is to remember that this is a once-off situation. This is not a recessionary situation. It's not a stock market decline. Prices are not declining because of economic factors, that we could have predicted. It's a natural disaster. That's exactly what it is. The economy is in hibernation. When it comes out of hibernation, these stocks are going to rocket back up the way that they rocketed down. And so it's important not to panic, and it's important to stick with your guns at this point. So that's my message for this week. As you go into the weekend, remember, this will pass. And if you sell everything now, it'll be just like 2008, 2009. You'll lose a lot of money, and it'll take you years to get it back. Don't make that mistake again. Anyway, this is Ted Bauman here. I'll be back with you next week with your Friday video. Remember, if you haven't subscribed to the Bauman Letter already, please do. I'm proud to say that the endless income portion of our portfolio has done extremely well under these circumstances. It has also suffered some declines, but it has beat the market quite significantly. So there's a lot of potential in there, and I encourage you to look at that portfolio, possibly by subscribing to the Bauman Letter. Anyway, take care, and I'll talk to you next week.